Divorce. It's a heavy word, isn't it? So much complexity packed into it.
Emotionally, logistically.
And financially. That's often a huge hurdle for people. And right where divorce and money meet, you find taxes, which, let's be honest, can be a minefield.
Absolutely. A real minefield.
So imagine you're navigating all that, trying to figure out spousal support, who pays tax, who gets a deduction. You think you know the rules, and then bam, you find out they completely changed a few years back.
Right. A fundamental shift.
And then, maybe even worse, you hear that even under the old system, the one that was around for decades, an official government watchdog found that billions, literally billions in taxes might still be slipping through the cracks every year, just from reporting mistakes.
It's pretty staggering when you see the numbers. It really feels like you said, walking a tightrope in the dark.
Okay, so let's shed some light here. We're going deep today.
Sure.
We're looking at U.S. alimony taxes, specifically what things look like after that huge tax law, the Tax Cuts and Jobs Act of 2017, TCJA.
That's the plan. And to help us, and you understand this, we've got some key sources. The main one is, frankly, a really eye-opening report from TCJA.
TCJA, remind us who they are.
Right, sorry. That's the Treasury Inspector General for Tax Administration. Basically, they're the IRS's internal watchdog, and their 2019 report gives us this, well, pretty stark view of the compliance problems, especially for those agreements under the old rules before the TCJA kicked in.
Okay, so that TCJA report is crucial for understanding the past rules and how they were, or maybe weren't, being followed.
Exactly. It highlights the enforcement gaps. And then alongside that, we're bringing in analysis from legal and tax experts, some of it updated very recently, like early 2025.
Good. So that helps us see what the TCJA changes mean now, and also clarify some things people might be wondering about, like stuff expiring in 2025.
Precisely. It gives us the current landscape.
Perfect. So for you listening, if you want to get a solid handle on this potentially confusing topic, divorce, money, taxes, always a mix without drowning in tax jargon, here's our mission today.
3 main things, really.
Yeah, first, we'll clearly lay out that big change in federal alimony tax rules from the TCJA, what actually flipped.
Second, we'll dig into what TCJA found. How well did the IRS manage compliance, especially under the old system? What were the challenges?
And third, we'll boil it all down. What are the practical things you need to know today? Whether you're paying, receiving, have an old agreement, a new one, what's the bottom line for you?
Exactly. It's about giving you that core knowledge, because this stuff, it really impacts the finances of so many people going through a tough time. Understanding these tax rules is, well, it's fundamental for compliance and just smart planning.
Okay, let's start right at the beginning then. Before we even get to the TCJA changes, what is alimony or spousal support in this tax context?
So at its core, alimony or spousal support, you hear both terms. It's basically a payment, or usually a series of payments, made by one spouse or former spouse to the other. The key thing for tax purposes, though, is that these payments have to be required by some kind of official divorce or separation document.
Like a court order.
Yeah, exactly. A court decree, maybe a formal written separation agreement that's legally binding, or some other court order. It can't just be, voluntary payments you decide to make. It has to be documented in the legal paperwork ending the marriage or separation.
Okay, so it's financial support mandated by the divorce process itself.
Right.
What's the legal idea behind it? Why does it exist?
The main goal is usually about financial stability for the spouse who earned less during the marriage. Courts often recognize that, one person might have paused their career or earned less to support the family or the other spouse's career.
Makes sense.
So alimony is meant to kind of bridge that economic gap after the split. It gives the receiving spouse some time, maybe, to become self-supporting or maintain a standard of living somewhat closer to what they had during the marriage, especially in, longer marriages.
Got it. And super important, you always hear this, alimony is not the same as child support, right?
Oh, incredibly important distinction, yes. They often get decided together in a divorce, but for taxes, worlds apart. Always have been.
How so?
Child support is money specifically for the kid's needs, and its tax treatment is simple and unchanged. The parent paying it cannot deduct it. The parent receiving it does not report it as income, period. It's just tax neutral.
Okay.
Alimony, though, is for the spouse's support. And that's where all the complicated tax rules and this big TCJA change come into play.
Right. So when judges or mediators are figuring out how much alimony, if any, what kinds of things do they look at? Our sources mention some factors.
Yeah, they look at a bunch of things, and it can vary a bit by state, but generally. How long was the marriage? Longer marriage often means more alimony consideration.
Okay.
They look at the income and importantly, the earning potential of both people. What was the standard of living during the marriage? Does the spouse asking for support actually need it? And critically, can the other spouse actually afford to pay it?
So it's a balancing act, trying to be fair based on the circumstances.
Supposed to be, yes.
Okay, that's the general idea of alimony. But the IRS, for tax purposes, especially under those old rules, before 2019, they had a really specific definition, didn't they? A checklist almost.
They absolutely did. For any agreement signed before January 1st, 2019, a payment had to tick all these boxes to be considered alimony for federal taxes, which then triggered that old deductible taxable treatment.
Let's walk through that checklist. What were the requirements?
Okay, first, the payment had to be in cash. That included checks, money orders, but not property.
So giving your ex the car title doesn't count as tax-deductible alimony.
Nope, not under the old rules. Had to be cash or equivalent. Second, payment received by or for the former spouse. Third, made under one of those official divorce or separation instruments we talked about.
The legal document, got it.
Fourth, you couldn't be filing a joint tax return together for that year. Usually obvious after divorce, but it's a rule.
Makes sense. You're separate tax entities now.
Right. Fifth, if you were legally separated but maybe not fully divorced yet, you couldn't be living in the same household when the payment was made. That was a specific requirement for separated couples.
Interesting, okay.
Sixth, and this one's really key, the divorce or separation document had to state, or it had to be clear under state law, that the payer's obligation to make the payments ends if the recipient dies.
Ends on the recipient's death. Why was that so important?
It really underlined that these payments were personal support for the recipient, tied to their lifetime. If the payments were set to continue to, say, their estate after they died, the IRS generally wouldn't consider it alimony for tax purposes. It might look more like a property settlement then.
Huh. That makes sense. It distinguishes it from dividing assets. What else?
And seventh, the payment could not be designated as child support or treated as part of a property settlement in the agreement itself. The wording in the document was critical.
So even if it felt like spousal support, if the decree called it child support or an equalization payment, the IRS would follow the label.
Generally, yes. The label in the legally binding instrument carried huge weight for the tax treatment under those old rules. If it said child support, it was treated as child support, no deduction, no income. If it said alimony and met the other tests, it was deductible taxable.
Wow. Okay. So the precision in drafting those agreements was vital back then.
Absolutely vital.
Were there things the IRS specifically said weren't alimony, even if paid to a former spouse?
Yes, they listed exclusions too. Child support, obviously, number one.
Right.
Non-cash property settlements, we covered that, only cash counts. Payments that were inherently part of dividing property, like one spouse buying out the other's share of the house.
Okay.
Also, payments made to keep up property that the payer still owned. Like if the payer kept the house but let the ex live there and paid the mortgage, those mortgage payments weren't alimony.
Because they're maintaining their own asset.
Exactly. Voluntary payments, anything not required by the official document, didn't count. And an interesting one in community property states, the recipient's share of income from community property wasn't alimony either.
Okay, that is a detailed list. It really sounds like you needed a lawyer who understood tax implications back then just to draft the agreement correctly.
You really did. Because getting it right determined whether you fell under that old system.
Which brings us right to the big change, the Great Divide, before and after the TCJA. Let's properly nail down that old rule first, the one from 1942 until, well, 2018, basically.
Right. The old rule, the standard for over 70 years, was pretty straightforward in concept. The person paying the alimony got to deduct those payments from their gross income on their federal tax return.
Okay, an above-the-line deduction, usually.
Yes, reducing their adjusted gross income. And conversely, the person receiving the alimony had to report those payments as taxable income on their federal return.
So for tax purposes, the money effectively moved from the payer's income calculation over to the recipient's income calculation. What was the logic behind that?
The main idea, the rationale you always heard, was about tax brackets. Usually, the payer is the higher earner in a higher tax bracket. The recipient is often the lower earner in a lower tax bracket. So by letting the high bracket payer deduct the payment, they save tax at their high rate. The low bracket recipient paid tax on it, but at their lower rate.
So the total tax paid by the two former spouses combined would be lower than if the payer couldn't deduct it.
That was the theory. The net effect was supposed to be a lower overall tax burden across both households, which meant the government collected less tax revenue overall from that specific money being transferred.
So it kind of acted like a small tax subsidy for alimony, making it slightly less expensive overall after tax?
You could definitely see it that way. It created tax efficiency. Let's use that John and Sarah example. Say Jason paid Sarah $2,000 a month under a 2015 divorce decree. Old rules apply. John deducts the full $24,000 for the year, 2K/12 from his income. Sarah receives the $24,000. She has to report it as income and pay taxes on it at whatever her marginal rate is.
Okay. And the IRS confirms this treatment for those pre-2019 agreements.
Oh, yeah. IRS Topic 452, which is guidance for taxpayers, explicitly states, for agreements before Jan 4 in 2019, payer deducts, recipient includes an income. Clear as day for those old agreements.
Got it. Decades of that system. Then, late 2017, Congress passes the Tax Cuts and Jobs Act. What did the TCJA do to alimony?
It completely flipped the script, just turned it 180 degrees, and this is crucial only for new agreements.
New agreements meaning
any divorce or separation instrument executed after December 31st, 2018. For any agreement finalized January 1st, 2019 or later, the federal tax treatment is totally different.
Okay, so what is the new treatment?
Under the new rules, the person making the alimony payments cannot deduct those payments on their federal tax return. No deduction at all.
Wow, okay. And the recipient?
The recipient does not report the alimony payments as taxable income on their federal return. It's received tax-free federally.
So it's gone from a tax shifting mechanism to federally tax neutral.
Exactly. Tax neutral at the federal level. The payer uses after-tax dollars to pay it. The recipient gets it federally tax-free. No reporting on either federal income tax return for the alimony itself. The key is that execution date, after December 31st, 2018.
That date seems absolutely critical. Okay, here's a tricky one. What if you have an old agreement, say from 2016, under the old rules, but then you modify it in, say, 2021? Does it automatically switch to the new rules because the modification happened after 2018?
Great question. That's a really important nuance, and yeah, it can definitely trip people up. The answer is not automatically.
Okay.
A pre-2019 agreement that gets modified after December 31st, 2018 can be switched to the new TCJA rules, but only if two things happen. One, obviously the modification date is after 2018. Two, and this is the clincher, the modification document itself has to explicitly state that the new TCJA tax rules will apply to the modified payments.
It has to say so in writing, in the modification.
Yes. It needs specific language opting into the TCJA treatment. If you modify an old agreement after the deadline, but the modification document is silent on the tax rules or doesn't have that specific opt-in language, then the old rules generally just keep applying. Payer deducts, recipient reports income, even for the modified payments.
Wow. So just changing the payment amount isn't enough. You have to consciously, explicitly agree in the legal document to adopt the new tax treatment. That requires real awareness during modification talks.
It really does. Very careful legal drafting is needed if you intend to switch. And it means you could, theoretically, have different parts of the same overall support obligation following different tax rules if they were modified at different times or with different language. Complexity.
Definitely adds complexity. So why did Congress do this? Why make such a fundamental change after 70 plus years? What was the reasoning?
Well, there were a few stated goals. One was tax simplification, getting rid of those deduction rules, and the need for the IRS to track the payer-recipient match, which, as we'll see, was problematic.
Okay, simplification. What else?
Another big driver, pushed by the change's supporters, was closing what they saw as a loophole. They felt the old system disproportionately benefited high-income payers who got a valuable deduction, reducing government revenue.
So revenue generation was a factor.
Oh, absolutely. By eliminating the deduction, the government expected to collect more tax. One source we looked at cited projections that this change would raise about $6.9 billion for the U.S. Treasury over 10 years.
Okay, simplification, closing a perceived loophole, raising revenue. Sounds logical from a government perspective, maybe. But was it popular? What was the reaction?
Not universally popular at all, no. It sparked quite a bit of controversy, especially among family lawyers and tax pros.
Why? What were the main concerns?
Well, think about the payer. They completely lose a significant tax deduction. That directly increases the after-tax cost of paying alimony for them. It makes it more expensive.
Right, which could make negotiations harder.
Exactly. If the payer doesn't get a tax break for paying, they have less financial cushion or incentive to agree to higher alimony amounts in the first place. It removes a tool that was often used in settlement negotiations.
Okay, so harder on the payer.
Yeah.
What about the recipient? They get the money tax-free now. Isn't that just purely good for them?
You'd think so initially, but maybe not always. Some experts predicted that because the payer loses the deduction and the payment is now tax-free to the recipient, courts and negotiators might adjust the amount of alimony downwards.
So the total payment might be lowered to reflect the new tax reality.
That was the prediction. The idea being courts might try to achieve a similar net financial outcome by awarding a smaller, tax-free amount, recognizing the payer's increased burden. So while it's received tax-free, the actual dollars received might be less than under the old system. The overall financial burden shifts more onto the payer.
That's a really critical point. The change affects not just reporting, but potentially the amount itself.
Yeah.
Okay, now fast forward to today. People hear about TCJA provisions expiring at the end of 2025. Does this alimony change go away then? Do we go back to the old deductible taxable system?
This is super important, and the answer is definitive no. Our sources are very clear. While many other parts of the TCJA, like individual tax rates, standard deduction amounts are scheduled to expire after 2025.
Right.
The change to the alimony tax treatment is permanent. It was written into the law without an expiration date. So for agreements made after 2018, the rule is no federal deduction for the payer, no federal taxable income for the recipient. That's the law going forward. It's not snapping back.
Yeah, that's a huge takeaway. Permanent change. New rules are here to stay federally. So you have this clear dividing line. Agreement date before 2019, generally old rules apply federally. Agreement date after 2018, new rules apply federally. And modifications need that special language.
You've got it. That's the core framework. Which then leads us to the next big question. How well is the system actually working? Especially with all those old agreements still out there operating under the deductible taxable rules, how good is compliance?
And that's where the TCJA report comes in again, the Treasury Inspector General for Tax Administration. They audited the IRS on this very issue.
Right. Their report came out in August 2019, and it specifically looked at how effectively the IRS was identifying and addressing discrepancies in alimony reporting, focusing mainly on those agreements under the old rules.
And what did they find? Was it a big problem?
A very big problem, according to their findings.
Yeah.
Just to give you a sense of scale, for tax year 2016 alone, that's before the TCJA train really hit, TGTA found over 569,000 tax returns claiming alimony deductions. And those deductions totaled over $12.9 billion.
Almost $13 billion claimed in deductions in 1 year. Wow.
Yeah. And TGT has said flat out that the mismatch where the payer claims a deduction but the recipient either reports nothing or reports less income, this discrepancy represents a substantial compliance gap.
A gap meaning potential unpaid taxes. Did they estimate how much?
They did. And they found the dollar amount of this gap was increasing significantly in the years leading up to the TCJA. It went from about $2.3 billion in potential underreported tax in tax year 2010 up to over $3.2 billion by tax year 2016.
$3.2 billion just from alimony mismatches in 2016 alone. That is a lot of money potentially not being collected.
That's a huge number. And what made it worse, according to TGTA,
What's that?
IRS management themselves admitted to TGTA that they only audited 5% or maybe even less of the discrepancy cases their systems identify.
5% or less of cases representing potentially $3.2 billion in unpaid tax. That seems shockingly low.
It does seem low. TG2 noted that the actual number of audits looking specifically at alimony deductions had dropped quite a bit, too. Fell from around 13,600 audits in fiscal year 2010 down to about 7,500 in fiscal year 2016.
Why the drop in audits if the dollar discrepancy was going up?
TG2 pointed partly to staffing cuts at the IRS. They mentioned specifically that the Correspondence Examination Unit, which often handles these kinds of document matching issues, had lost nearly 300 staff members in just the few years before 2016. Fewer people means fewer audits can be done.
So the problem's getting bigger, the potential tax loss is growing, but the IRS's ability to actually examine these cases is shrinking. That sounds like a recipe for a widening gap.
That's exactly the picture TGT painted. And they didn't just point to fewer audits. They found specific problems in how the IRS was handling things, even for the cases they did identify.
Okay, like what? What specific issues did TGT call out?
Well, one big one was the failure to use other tools besides audits. TGT pointed out that back in a 2014 audit report, the IRS had actually agreed it would develop a strategy that included using soft notices.
Soft notices, right. Those are the informational letters.
Yeah.
Not quite a not a demand.
Exactly. It's a letter saying, hey, we see you reported X, but we have information suggesting maybe it should be Y. Could you check your records? It's less threatening, encourages voluntary compliance. TGT thought this could be a great tool for the 95% plus of discrepancy cases that weren't getting audited.
Makes sense. So by 2019, when TGT did this follow-up, had the IRS started using those soft notices for alimony?
Nope. They hadn't even evaluated using them for alimony specifically.
Why not? What was the reason?
The IRS gave a couple of reasons. Resource constraints, they said they were focusing on other things like refundable tax credits, and they also raised privacy concerns.
Privacy? How so?
They argued that sending a notice about an alimony discrepancy might implicitly reveal information about the other taxpayer involved, which they felt could violate disclosure rules.
Did TCJA buy that argument?
Not really. TCJA pushed back, saying you could design the notices carefully to avoid specific disclosures. And they pointed out, crucially, that the IRS already uses soft notices successfully for other types of income mismatches like interest, dividends, even gambling winnings where similar third-party information is involved. So why not alimony? TCJA saw it as inconsistent.
Interesting. So a potentially useful tool wasn't being used, despite billions potentially slipping away.
Yeah.
What else? Did TCJA find issues with the information itself, like what the taxpayers were providing?
Yes, and this is a big one. The recipient's taxpayer identification number, their TIN, usually a Social Security number.
Right. The payer needs to put that on their return when claiming the deduction under the old rules.
Correct. It's required by law. But TCJA found the IRS's processing systems weren't doing a good job of making sure the TTN provided was actually valid.
Meaning, it wasn't a real number, or it didn't match IRS records.
Exactly. It was invalid, didn't match an SSN or an official IRS-issued TN. TCJA looked at tax year 2016 again. They found over 2,100 tax returns claiming alimony deductions totaling more than $38.5 million, where the recipient TNN provided was just plain invalid.
And the IRS just processed the return and allowed the deduction anyway.
In those cases, TGT reviewed, yes, the system didn't automatically reject the return or disallow the deduction just because the recipient's TIN was invalid.
So theoretically, someone could have just put down a fake number, claimed a big deduction, and it might have sailed right through.
It appears that was possible based on TGT's findings for those specific returns. And they estimated the potential unpaid tax just from those cases with invalid TINs was $2.4 million for 2016 alone. Over 5 years, potentially almost $12 million.
Just from bad ID numbers. Wow. And isn't there supposed to be a penalty if you don't provide the correct TIN?
Yes. There's a $50 penalty specifically for failing to provide a required or valid TIN on your return. But TTF found the IRS was also failing to assess this penalty most of the time in these situations.
How often?
Remember those 2,168 returns with invalid TINs in 2016? Penalties were assessed on only 66 of them.
66 out of over 2,000. That's like 3%.
Precisely. TGTA calculated over $100,000 in penalties went unassessed just for that 1 year, potentially over $500,000 over 5 years. The reasons. Sometimes examiner error, sometimes issues in how the cases got routed internally.
So why wasn't the IRS just rejecting returns with invalid TINs up front, or at least demanding the correct number before allowing the deduction? What was their justification?
IRS management told TGTO they lacked math error authority to automatically deny the deduction just because the TIN was invalid outside of a formal audit. Math error authority lets them fix obvious calculation mistakes quickly. They argued an invalid TIN wasn't a math error.
Okay, maybe they can't deny it automatically, but could they do more to get the right number?
That was TGT's point exactly. They argued that lacking math error authority doesn't stop the IRS from, say, rejecting an e-filed return if the TIN is invalid, or flagging a paper return with an invalid T-line and sending it to an error unit to contact the taxpayer and get the correct number before processing the deduction. TGTA said the IRS does reject e-files for missing TINs, but wasn't consistently validating the provided TIN.
So they had options to be tougher on validation up front, but weren't fully using them. Any other glitches TCJA found?
Yes. One more technical one, a programming bug. For tax years 2015 to 2017, if someone claimed an alimony deduction under $5,000, the IRS system was sometimes incorrectly replacing the actual recipient TIN provided with placeholder number like all nines in some of its internal files.
Seriously?
Yeah. Apparently the correct TIN is still stored elsewhere, but this processing error existed, potentially making it harder to match things up internally. TGT pointed it out, and the IRS fixed that specific bug effective January 1st, 2019.
Okay, so summing up TGT's findings. Discrepancies are growing, billions potentially lost, audit rates are down, they're not using soft notices, they're struggling to validate TINs, not assessing penalties consistently, and even had programming glitches. Based on all that, what did TCJA tell the IRS they should do?
They made several direct recommendations. First, fundamentally change the compliance strategy to actually address the multi-billion-dollar gap, specifically including using those soft notices.
Okay.
Second, strengthen the upfront TIN validation process, maybe reject e-files with invalid TINs, route paper returns with invalid TINs to error resolution to get the right number from the taxpayer.
Makes sense.
And third, make sure that $50 penalty for not providing a valid TIN is actually assessed when it's supposed to be.
Pretty clear recommendations.
Yeah.
How did the IRS respond? Did they agree to do these things?
It was a mixed bag. They agreed to tweak their audit selection filters to better target risky cases, which is good, but they disagreed with implementing soft notices for alimony, sticking to their resource and privacy concerns, even though TCJA had countered those points.
So no on the soft notices. What about the tie-in validation?
They disagreed with mandatory upfront validation, like rejecting e-files. They said they preferred handling TIN issues through their existing compliance functions, like audits, rather than at the initial processing stage.
And the penalties?
They agreed in principle to do better on assessing the $50 penalty, but TCJA sounded skeptical about how quickly or effectively that would be implemented. They also only partially agreed to route paper returns with invalid TINs to error resolution, again citing resource limits on contacting every single taxpayer.
So it sounds like despite TCJA laying out a clear problem with billions at stake, the IRS response often came back to, we don't have the resources, or we prefer our current methods, or we disagree with your approach.
That's a fair summary of the exchange outlined in the report. It really paints a picture of an agency struggling, whether due to resources or procedural choices, to effectively enforce compliance even under the old well-established rules, leading to significant potential revenue loss.
Okay, this is a lot to absorb, especially knowing those old rules are still relevant for many people. Let's bring it back to today. For you, listening right now, maybe paying or receiving alimony, what are the absolute must-know practical takeaways from all this?
Number one, absolutely number one. Know the date your divorce or separation agreement was finalized, legally executed. That date is everything for federal taxes.
Step one, find that date on your decree or agreement.
Exactly. If that date is before January 1st, 2019, then the old federal rules probably apply to you. Meaning, if you're the payer, you likely can deduct those alimony payments on your federal return. If you're the recipient, you must report those payments as taxable income on your federal return. Report it correctly. And payers, remember, you need that recipient's valid TIN, usually their social security number on your return. Form 1040, Schedule 1. As TCJA showed, missing or invalid TINs are a compliance red flag and could lead to penalties or questions.
Okay. And if the execution date is after December 31st, 2018?
Then the new TCJA federal rules apply. Payer, you cannot deduct the alimony federally. Recipient, you do not report it as federal taxable income. It's federally tax-free for you. Generally, no federal reporting needed for the alimony payments themselves under these new rules.
Simple enough for new agreements. But what about that modification scenario? Again, pre-2019 agreement, modified later.
Right. You have to look closely at the modification document itself. Does it contain specific wording that says the new TCJA rules, no deduction, no income, now apply? If yes, follow the new rules. If no, or if it's silent on taxes, then the old rules likely still apply. Payer deducts, recipient pays tax. You need to read your specific documents carefully.
Check the date, check the modification language, that covers the federal side. But you flagged states earlier, that adds another wrinkle.
A potentially big wrinkle, yes.
Yeah.
Federal law changed, but states have their own income tax systems. And not all states automatically follow federal changes.
So my federal treatment might not match my state treatment.
Could very well be the case. Some states, like California, for example, decided not to conform to the federal alimony change. So even for a post-2018 agreement where there's no federal deduction income, in California, the payer might still deduct it on their state return, and the recipient might still have to report it as income on their state return. They stick to the old rules for state tax.
Wow. Okay. Any other examples?
Other states like New Jersey and New York did conform to the federal change. So in those states, for post-2018 agreements, it's no deduction, no income at the state level either, matching the federal treatment.
So the bottom line is, you absolutely cannot assume your state follows the federal rule. You must check your specific state's alimony tax law.
Must check. Don't guess. Getting it wrong on your state return can lead to notices, penalties, interest. Just because it's federally tax-free doesn't mean it's state tax-free everywhere.
Okay, with all these layers, original date, modification language, state law variations, plus the IRS compliance issues we talked about. What's the single best piece of advice for someone trying to navigate this?
Honestly, get personalized professional advice. Seriously. Given how complex this can get, especially with older agreements, modifications, or state differences, trying to figure it out alone from general info is just risky.
Talk to a tax pro.
Yeah, talk to a qualified tax professional, a CPA, an enrolled agent, or maybe a family law attorney who really understands the tax side of divorce. They can look at your specific documents, factor in your state's laws, and tell you exactly how you should be treating these payments for tax purposes. It's worth it for peace of mind and accuracy.
Makes total sense. Avoid the guesswork. Now, alimony is just one piece of the financial puzzle in divorce. Our sources touch briefly on other tax things people need to consider. Can you highlight a couple?
Sure. Two really common ones are claiming the kids as dependents and how assets get divided.
Okay, dependents first. Who gets to claim the kids? That affects tax credits, right?
Big time. It affects things like the child tax credit. The general federal rule is the custodial parent claims the dependent.
And custodial parent means?
For tax purposes, it's simply the parent the child lived with for more nights during the year. Doesn't matter what the divorce decree says about custody, it's about where the child physically slept more often.
Okay. But can the non-custodial parent ever claim the child?
Yes, they can, but only if the custodial parent agrees and signs a specific form releasing their claim for that year. That's IRS Form 8332. The non-custodial parent has to attach that signed form to their tax return.
So if a non-custodial parent gets that form and claims the child, do they get all the related tax benefits too, like head of household status or child care credits?
No, and that's another key distinction people miss. Even with Form 8332, allowing the non-custodial parent to claim the dependency exemption and the child tax credit, usually the non-custodial parent still cannot claim head of household filing status, the child independent care credit, or the earned income credit based on that child. Those benefits typically stay with the custodial parent.
Wow, that's complicated. So who claims the child really dictates which benefits each parent might get?
Exactly. Needs careful consideration.
Okay, what about dividing assets like the house, stocks, retirement accounts? You said the transfer itself isn't usually taxed.
Correct. Generally, when assets are transferred between spouses or former spouses incident to divorce, there's no immediate tax consequence. The person giving the asset doesn't recognize a gain or loss, and the person receiving it doesn't pay tax right then.
But there's a catch, right? Something about basis.
Yes. The big catch is called carryover basis. The person who receives the asset in the divorce also receives the original tax basis that the asset had when the couple first acquired it, or whatever basis the transferring spouse had.
Why does that original basis matter so much?
Because basis is what you subtract from the sale price when you eventually sell the asset to figure out your taxable gain. If you receive an asset in the divorce that has appreciated a lot, like stock bought cheap years ago, or a house that's gone up in value, you inherit that low original basis.
Meaning, if I sell it later, I pay...
Precisely. You are responsible for the capital gains tax on the entire appreciation from the original purchase date right up until you sell.
So getting $100,000 in cash versus $100,000 worth of stock that was bought for $10,000 are very different outcomes tax-wise.
Hugely different. The cash has no built-in tax liability. That stock carries a potential $90,000 taxable gain, $100K of value, $10 basis. If you sell it, you owe tax on that $90K. So when dividing assets, you absolutely have to look at the tax basis, not just the current market value, to understand the true after-tax value you're receiving. It's a critical negotiation point.
That's a fantastic point. Tax basis is key. It really sounds like taxes are just woven into every financial aspect of divorce.
They really are. Ignoring them can lead to some very unequal outcomes down the line, even if the division looks fair on the surface initially.
Okay, this has been incredibly informative, a real deep dive. We've gone from defining alimony to the massive TCJA shift, the IRS's compliance struggles revealed by TCJA, and these crucial practical points for taxpayers.
Yeah, to recap the big federal picture. Agreements after December 31st, 2018. No federal deduction for payer, no federal income for recipient. And that change is permanent, not expiring.
But agreements before 2019 generally still follow the old rules: payer deducts, recipient reports income, unless a later modification specifically says otherwise in writing.
Right, and that TCJA report showed, even with those old rules, there was a huge compliance gap. billions potentially uncollected, and the IRS faced real hurdles in enforcement resources, TIN validation, penalties.
Plus, always remember the state tax rules. They might differ from the federal rules, so you have to check your specific state.
Absolutely. So know your agreement date, check modifications, know your state's rules. That's paramount. And getting professional advice is usually the smartest move.
Which leads us to our final thought for you, something to chew on. The TCJA was partly about simplification and closing a loophole. But that TGT report showed the old system was already leaking billions due to compliance issues. So does the government struggle to enforce the old rules suggest the old system itself was just too hard to administer effectively? Or is it simply that tax administration on this scale is just inherently incredibly difficult, regardless of the rule?
That's a great question. Policy intent versus the messy reality of implementation. And looking ahead, will the new way, no deduction, no income, truly be simpler and raise the revenue expected now that it's permanent? Or will new complexities arise? Maybe couples will structure support differently now, avoiding the term alimony altogether, leading to different kinds of financial arrangements and maybe new disputes.
Interesting possibilities. How will divorce settlements evolve without that old tax framework? Definitely something to think about as the tax world keeps changing. Well, that wraps up our deep dive on U.S. alimony tax treatment post-TCJA.
We really hope digging into these details, the rules, the TCJA findings has given you some valuable insights.
We'll catch you on the next deep dive.